This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We've gone through that, haven't we? We've gone through that page. Page 39, you've read it, I've talked about it. So 40, Audit Committee, still the big one, still the Audit Committee. Look at the others, the risk, the social, environmental, ethics. We'll look at those in time. But we're on to page 39, still with therefore the Audit Committee and internal audit. As part of their obligation to ensure adequate and effective controls, Audit Committee is responsible for the activities of internal audit. Who better than an internal audit department within the company to assess and consider and improve internal controls in order that we can achieve a corporate governance. But I'm worried about what's meant by the expression corporate governance. How would you describe corporate governance? How would you define corporate governance?
System of managing and controlling companies.
It's a system by which a company is controlled and directed and controlled. Yeah. And there's a number of elements, aren't there, to corporate governance? There are, aren't there, a number of elements to corporate governance. I can't remember for the life of me what they are. I can't remember. There's about 9 or possibly 10 elements of corporate governance. Who? Yeah, but it's no good writing that, is it? It's no good writing that in the exam. H.
Honesty.
What's another word for honesty? What's another word for honesty? Probity. Probity. And then there's an A. What's the A? You're hogging the show, you are. You're taking the opportunity away from your colleagues to let them give the others a chance. What's the A?
Accountability.
What's the I?
Independence.
All right, what's the R? You see? Now then, you were happy with the first two, and then what happened? What's the R? Responsibility.
Decision-making.
Decision-making is next. Now you're stealing the show. R. What John has? Reputation. I. No, we had independence. The other I. Integrity. F. Fairness. And T. All right. And what does the E.J.F. Jello-Jockle remind you of? E.J.F. Jello-Jockle. Who? Pink lava, yes, pink lava. I can't remember what pink lava is now. Oh dear, what's pink lava? Primary and secondary. I? Internal and external. N? Narrow and wide. K? And the other one? Known and unknown. L? And illegitimate. A? Active and passive. V?
Voluntary.
And involuntary. R? Recognised and unrecognised. All right, good. Can you give me 8 types of internal control? Now, if I cover that page up, can you give me 8 types of internal control? Organizational.
Segregation of duties.
Who?
Segregation of duties.
Yeah, I'm trying to go through it in the mnemonic style, though, because I can't remember it any other way. A. Authorization. P. Physical. S. Segregation. P. Personnel. A. Arithmetic and accounting. S. Supervision. M. Management. Good. Good. As part of their obligation to ensure adequate and effective, the Audit Committee is going to be responsible for the activities of the internal auditor, because we already established before break that the internal auditor ideally will be reporting direct to the Audit Committee about their findings and about their recommendations, but they should of course also be reporting to the Board of Directors, these people who are involved in the day-to-day management. So the Audit Committee should monitor and assess the role of the internal audit function within the entity's overall risk management system and check the efficiency of the internal auditors. This is presuming, it's all presuming, that the Audit Committee A is competent, which they should be, because we should only be appointing people of proven ability, but we're also assuming that they have the time to do this. Now, being directors, they are expected and authorised to delegate responsibilities, but they have this supervisory, this monitoring role, and therefore the work of the internal auditor will be directly, not controlled, but monitored by the Audit Committee, and the internal auditor will be reporting on a regular, but how often is regular, a regular basis to the Audit Committee, and the Audit Committee can then assess the recommendations and the reports of the internal auditor to determine if there's any better way, any way that we could improve the internal controls of the company. They will approve the appointment or the removal of the chief internal auditor. The Audit Committee will approve the appointment and or removal of the chief internal auditor. They'll ensure that the internal audit function has direct access to the chair and is accountable to the Audit Committee. Review and assess the annual internal audit work plan. Agree with the chief internal auditor on one of their regular meetings where the internal audit department shall go next, what they should focus on. Do you know, so far as the Internal Audit Society or Society of Internal Auditors is concerned, there's only one way in which an audit should be carried out. According to them, there's only one way to carry out an audit, so far as they're concerned. It's called risk-based auditing, and they will identify, let their minds flow and identify the potential risks that a company may face, and then work out how we can manage those risks. So the Audit Committee is going to have to review and assess this annual internal auditor's work plan. They receive reports concerning the work of the internal audit function. We've worked on this, we've assessed these risks, and this is how we recommend that those risks shall be managed. We review and monitor management's response to the internal auditor's findings. Management may say that's going to be too expensive, or we don't see this as a risk, or yes, we accept what you're saying, but we're going to ignore it. So management has got to respond to the internal audit department's findings, ideally in accepting the internal auditor's recommendations about the management of the risk. Ensure that the recommendations are implemented and help to preserve the internal audit function from pressures which might otherwise impair their objectivity. Help to protect the internal auditors. The Audit Committee should be instrumental in preventing the internal auditors from being at all involved in day-to-day transaction recording. Even though some department may have suffered some major outbreak of some dreadful disease, it should not be the internal auditors who are expected to step into the gap and take over the recording of the data that department is now unable to do. It should be somebody else. We need to buy in expertise from outside, but it shouldn't be the internal auditors, because then they're under a self-review threat. How can they then audit the work that they have done? Audit Committee should meet with the internal auditors at least once a year. At least once a year. I would have thought in practice that should be rather more frequently than just once a year, but at least I've left the door open and said they should meet at least once a year to discuss audit-related matters. It's possible that even a listed entity doesn't have an internal audit function. It's possible that even the big companies, the companies listed on the stock exchange, do not have an internal audit function. The management may have decided that we don't need an internal audit function. Whatever the internal auditors are likely to achieve, it's not likely to be beneficial in terms of the cost of having an internal audit department or an internal audit function. If there's no audit committee, management should review the situation annually and make any appropriate recommendations. And if there is no internal audit department, then that now must be disclosed in the financial statements. If there is no internal audit department or no internal audit function, this now falls to be disclosed in the financial statements. The directors have reviewed the situation as to whether or not the company justifies an internal audit and have decided that we can last another year without, or we are satisfied that the controls are operating in such an effective manner that no internal audit function would be justified. But there needs to be a statement that we do not have an internal audit function or no internal audit has been carried out. Equally, they may decide that an internal audit should be carried out, but this doesn't justify the expense of establishing an internal audit department, and in that situation, who do they turn to? If they're not prepared to have their own internal audit department, who would they turn to carry out the internal audit function? Who better than the external auditors? But not in America. Why? What do you wear between your foot and your shoe? Don't say tights. What do you wear between your foot and your shoe? Socks. Socks. Sarbanes-Oxley. Yeah. Sarbanes-Oxley. So if you're in America, then Pricewaterhouse external auditors could not also be Pricewaterhouse internal auditors. And it's not an ideal situation anyway. Even in the UK under a principles-based system, or in Europe, it's not an ideal situation for the external auditors also to carry out an internal audit function, because you're then reviewing the work of your colleagues. Anyway, there should be two separate departments or two separate teams involved, one team doing internal audit and another team doing external audit. But even in that situation, if you men from the Big Four were the team of internal auditors, you should not also be the external auditors, because even the women from the Big Four are then faced with the prospect of reviewing your work, and that then means that they're reviewing and criticizing, maybe, the effectiveness and efficiency of their colleagues who carried out the internal audit. It should not happen. Page 40, Audit Committee is responsible. The Audit Committee is responsible for overseeing the entity's relationship with the external auditors. This frightens me. Whether I'm being too simplistic or not, I really don't know, but this frightens me, because I used to be an auditor and I grew up as an auditor and I worked for a Big Four firm. And I'm now being told that the Audit Committee is responsible for overseeing the entity's relationship with the external. That itself is not frightening, but one of the matters coming down that we're coming to does surprise me. Responsibility is given by the Combined Code, and it also states that the Audit Committee should. They should have the primary responsibility for recommending the external auditors for appointment, or reappointment, or even removal. So it's the Audit Committee who are responsible for selecting the identity of the external auditors. I can see the sense in taking it away from the Executive Board. I can see the sense in that, because it will improve and strengthen the independence of the choice of the external auditors. So that I'm happy with. They should oversee the selection process when replacement auditors are being considered. It would not be unusual these days, it certainly didn't happen when I was a trainee, but it would not be unusual these days to ask typically the Big Four to submit a competitive tender to determine which of the Big Four is the one that we now want to select to replace the existing auditors. That I can almost accept. The Audit Committee will oversee this process for selecting. Approve the terms of the external auditors' engagement and their remuneration. Okay, part of the competitive tender from the Big Four will be, this is what we intend to do, this is how we intend to approach it, this is the sort of figure we would expect to be invoicing you. So approve the terms, not get involved in the negotiation, just the approval. Develop procedures where the Audit Committee can annually ensure the external auditor's continuing independence and objectivity. There needs to be some procedure where the Audit Committee negotiates with Deloitte or communicates with Deloitte in order to ensure that Deloitte remain independent and that Deloitte themselves are taking steps to make sure that their employees remain independent. That again, I can see the sense of that. But what about this next one? Review the scope of the audit with the external auditor and satisfy themselves that the scope is sufficient. That frightens me. Who is the person or who is the body who is signing the audit report? It's the external auditors. On what basis do the external auditors reach and express their opinion? They reach it on the basis of the scope of the work that they have carried out and the findings that they have decided upon as a result of the work that they have carried out. Who decides on the scope that the external auditors are going to implement, to carry out? The external auditors. They will plan the audit and they will say, we need to be looking at so many items, we need to be looking at so many transactions, we need to be thinking in terms of materiality levels. This is the scope with which we are happy. And now the Audit Committee is going to get involved and agree, review the scope of the audit. And the Audit Committee is going to satisfy themselves that the scope is sufficient. And presumably, therefore, not only satisfy themselves that the scope is sufficient, but also that it's not too much. And then we really do have a problem. Because if we say to the external auditors, we think you're doing too much on these particular areas, and yet it's the external auditors who are going to have to form and express their opinion based on the scope of the work that they felt was necessary, I can see conflict, argument. Maybe I'm wrong. Maybe as I introduced it, maybe I'm being too simplistic or too naive. But that potentially could be a major worry for me, that these people, independent of my client company, are telling me whether or not they feel that my work is sufficient. Oh.
Maybe do less work and charge less money.
Maybe do more work and charge more money. Yeah, but then we get back to the problem about the scope of their work and the remuneration that they're going to charge. And if the big four firms send in the fixed tenders and competitive tenders and hope to win the audit, and then they're told that the Audit Committee thinks we should do more work, then we get again into a conflict situation.
But this is more like if they want agreed upon procedures, review or...
All right, if they want agreed upon procedures or review or prospective financial information, then I can understand that, yeah. Then that would be additional, that will be over and above the routine audit. But that's not what this point says, and this point's been taken from the books.
The scope is just this,
Just the scope of the audit.
if it's review or an audit.
But that's not an audit, is it? A review procedures and agreed upon procedures, a review exercise and agreed upon procedures are not part of the audit. No. Ensure that appropriate plans are in place for the audit at the commencement of the audit. This is a role of the Audit Committee. Tell me what you think you understand by that point. They should carry out or ensure that appropriate plans are in place for the audit, actually before the start of the audit. Ensure that appropriate plans are in place for the audit so that we're ready for the big four firm to descend upon us and start doing their audit. We've got to ensure that the executive and the management are already prepared, they're already set up, we've got a room allocated for the auditors so that they can go in and start doing their audit work. And it's the Audit Committee who want to ensure that this room is ready and that internet access is available and dedicated telephone lines are available, that all the books, accounting records, all the computers are available for access. And it's the Audit Committee's job to make sure that the executive and the management are planned for this audit visit. In order to ensure, I suppose, in order to ensure that the auditor's visit is carried out in a manner which is efficient, effective and economic, and that the auditors are not wasting time because stuff is not ready for them. And they should carry out a post-audit review, so at the end of the audit, the external auditors again will contact the Audit Committee, and a post-audit review will then be carried out by the Audit Committee to see what the external auditors have found, what they've recommended, whether the conclusions that they've reached on the efficiency, effectiveness of the internal controls are acceptable in the view of the Audit Committee, and whether or not it's necessary to implement any recommendations. Page 41, the Combined Code requires that the entity's board should maintain a sound system of internal control. We're back again. I taught an internal audit course here about 3 years ago now, only for 3 or 4 days, because the Society of Internal Auditors had thrown their doors open and said to anybody that was interested, any ACCA qualified who was interested, that if they did 1 4-hour exam instead of 4 3-hour exams, 1 4-hour multiple choice exam instead of 4 3-hour exams, then any ACCA member who passed that exam satisfactorily could then become a member of the Society of Internal Auditors. And one of the things I said, I must have said it 20 times a day, was that the board should maintain a sound system of internal controls. Keep a sound system of internal internal controls over and over and over again, in order to safeguard the assets and protect shareholder investments. The issue is how much the entity should tell its shareholders about the internal control system. It's the board who are required to maintain a sound system. The question I'm now asking is, how much should be communicated to our shareholders and other stakeholders, therefore, about the internal control system? You see, the directors are only agents. They're working for the principal, they're working for the company, and the company is represented by the entirety of its shareholders. Surely the principal should be acquainted, should be told of the effectiveness of the internal control system. Can you see any argument against that? Can you see any argument against the concept that the letter of recommendation written by the external auditors should not be reproduced and sent to the shareholders? Can you see any argument against it? Can you? Yes, of course there is. When you Big Four auditors write a letter of recommendation, when you write what used to be called a weakness letter, identifying where you have identified weaknesses in the systems, and therefore the potential errors that could arise and the potential fraud that could arise if this weakness is not addressed, if this risk is not managed, then you're going to be writing your letter saying this could happen and that therefore could happen, and if that happens then this will happen, and we recommend therefore that you should change your system. This letter that the external auditors write at the end of each of their audit visits, this letter is full of nastiness. It's full of mistakes. It's not the letter's full of mistakes. The letter is full of the mistakes that the auditors have found and the weaknesses that they've found. And the system is just as a non-existent system, and is so relaxed and uncontrolled and unsophisticated that anyone could perpetrate a fraud unless we address the problems of these risks which are involved in the system. So these external auditors are going to be writing their report, their recommendation letter or weakness letter, and it's going to be full of horror. By definition, no attempt is ever made. No attempt, and we can ask any of these people in the room here who've written weakness letters, no attempt is ever made to say, we found just these mistakes and everything else we checked was perfect. There's no attempt made to identify any complete section or application of the accounting system that says we found no mistakes, we conducted 100 tests and found no mistakes at all. We don't do that. All they do is write in the letter the mistakes that they have found. Now, can you imagine being a shareholder and you get a 4-page letter from the auditors that says that was wrong, that's weak, that's a potential fraud. Good God, is there anything right in the company? It would be hell to read that as an uneducated shareholder, as a person not used to reading or not understanding the purposes of a weakness letter. Never, 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 ever would you be inclined to show a shareholder your letter of weakness, unless they happened also to be a director, but you're showing it to them in their capacity as a director. So no, don't. The issue is how much should they tell the shareholders about the internal control system? The answer is nothing. Tell them nothing. Keep them in the dark. Treat them as mushrooms. As owners of the entity, shareholders are entitled to know whether the internal control system is sufficiently strong to safeguard the assets. The board should once a year review the effectiveness and report to the shareholders the results of that review. That's fine. We have reviewed the effectiveness of the internal control system, and we're satisfied that the system is appropriate for the size of organisation that we are. But that then becomes a glib, throwaway line, doesn't it? I don't think you're ever likely to find the director saying, we've reviewed the effectiveness of the internal control system and we're not at all happy about it. We think it's a really poor system and we're very sorry that we've allowed this to continue for so. You're not going to find that. So the review should cover all material controls, including financial, operational and compliance, as well as risk management. In addition, shareholders should be told through the financial statements about the work of the Audit Committee. There will be a report. The report of the Audit Committee. At the annual general meeting, the chair of the Audit Committee should be available to answer shareholder questions. Internal audit reporting, this is an example, just an example, the objectives of the work, the reason, and then an example. The report section, the objectives will be identified. In the reason, there will be an explanation of why we've chosen this objective, and then an example for a payroll audit. Check whether wages are paid to the correct individuals. Check the deductions from gross pay are properly calculated. The summary of the process undertaken describes how we've done it, and the example would be the recalculation of deductions was performed for a sample of 50 monthly and 50 weekly wage payments. In the audit opinion, the reason is to summarise whether the internal auditors feel that the control is working as it is intended. In our opinion, the control is working as intended. Recommendations. The reason is to highlight areas of control weakness and suggest the course of potential action to address that weakness. We recommend that new employees are only added to the payroll on receipt of an appropriately authorised form, whatever the authorised form number may be. You're not likely to be asked to write out an internal audit report. I cannot possibly see David Campbell asking you to write out an internal audit report. He may ask you for the headings, the section, the reason why you've done it and your findings. He may ask you for that, but he's not going to ask page 42. It's not going to happen. Page 43, roles and functions of an audit committee. Create a climate of discipline and control. This is the culture thing. Create a climate of discipline and control, leading to a reduction of opportunities for fraud. If the climate is a controlled climate, if there is discipline within the climate, then the possibilities of fraud being perpetrated by any employee, whether it's senior or junior, will be reduced. Lend an air of credibility and objectivity in the financial statements, and that itself will increase public confidence. The fact that an audit committee exists will be of comfort to potentially, and primarily I suppose, the institutional, the big investors, because they know that there's people, a body of people supervising the activities of the executive and of the management. And this body of people, proven ability in business and finance, are watching out. And so they're lending this air of credibility and improving the quality of the information which is within the financial statements. Assist the CFO by providing a forum. The CFO may be faced with, shouldn't be, a big organisation, but may be faced with a need to discuss matters. And if the CFO does, is he going to discuss them with human resources or with the production director who don't necessarily know anything about finance, financial applications, IFRS compliance, exposure drafts? They don't know these things. What's the point in the CFO talking to the sales director about how we would best comply with IAS 39? There was no point, but they can discuss it with the Audit Committee. So help the CFO, assist the CFO by providing a forum. Review the financial statements to improve the quality of reporting. Not only then lend an air of credibility and objectivity, but to see if there's anything that could be better expressed, better explained, better disclosed. So review the financial statements to see if there's any way in which the information contained therein could be improved. They bring independent judgments, their objectivity, their independence. Remember, one of the prime characteristics of the Audit Committee members, and therefore the NEDs generally, is that they should be independent. There should be no relationship between them and the executive board other than the fact that they are directors of the same company. So independent judgment needs to be brought by these NEDs and therefore by the Audit Committee. Strengthen the position of the internal auditor. How does that happen? How would the existence of an Audit Committee strengthen the position of the internal auditor? It's a layer above the executive. It's somebody more important or higher in the ranking than the executive directors. The internal auditor should have no fear about reporting to the Audit Committee. They may have fears about reporting to the executive because the executive, in some situations, will have the power to dismiss the internal auditors. But if you report to the non-executive Audit Committee, then we have this body of independent, professional, authoritarian people who are able to listen to the internal auditor's reports and concerns and complaints. Strengthen the position of the external auditor. Ooh, how does that happen? It happens because, again, with the situation, the external auditor is concerned that they don't jeopardize the working relationship that they have when they're discussing matters with the executive board. If the external auditor's got a body of people above the executive board to whom they can express their concerns, then it will possibly, arguably, make them more willing to open up in those discussions and therefore to speak their mind and not be frightened about damaging the relationship. So the position of the external auditor is also strengthened. Assist in the resolution of disputes between external auditor and executive board. Does that ever happen? Do the external auditors ever finish up in a dispute with the executive board? Well, you may or may not have you auditors may or may not ever have come across it, but trust me, it does happen. That executive management and external auditors can find that their relationship is rather tense. It's rather awkward because the external auditors have found matters or feel that they have found matters or they've identified risk which maybe the executive board had thought that they had resolved the risk. The external auditors say, no, it's still there. And tension can arise. So there may be a dispute between the external auditor and the executive board. And the Audit Committee can act as arbiter, can act as referee, can act as the central point so that the argument, the dispute, can be argued through the Audit Committee. And then down at the bottom there, remember Clarissa. Who's Clarissa? No? Create a climate, lend an air, assist, review, independence, strengthen, assist, Clarissa. It's a mnemonic. It's a mnemonic. Create, lend, assist, review, independent, strengthen, assist. Clarissa. And do we know Clarissa's family name? Clarissa, before she got married, was called Whistle. And she married a man called Blower. So she's Clarissa Whistleblower. Another role or function of the Audit Committee is to lend an ear to the whistleblowers, to provide an ear to the whistleblowers, so that people are not frightened about blowing the whistle for the benefit of the company, and therefore for the benefit of society. Clarissa. So Clarissa goes in hand, doesn't she? Where are our other three mnemonics? What was OAP's pattern? Oh. What was O? Stop it. You think I can't see you cheating? Organization controls. A. Authorization. P. Physical. S. Supervision. Think of Superman. He had supervision, didn't he? S. P. Personnel. A. Arithmetic and accounting. S. Segregation. M. Management. Okay. What was the other one? We had another one, didn't we? Oh, we had the E.J.F. Jalajokel. Primary and secondary. I. Internal and external. N. Narrow and wide. K. Known and unknown. What comes next? L. That's right. What's L? Legitimate and illegitimate. A. Active and passive. V. Voluntary and involuntary. R. Recognised and unrecognised. And that just leaves us with the fourth one, doesn't it? And what was the fourth one? The fourth one. H. Come on, don't lie to me. Don't lie to me. H. H is... What's another word for honesty?
Starts with P.
It starts with P. It starts with P and an R as well. Probity. Honesty. And then what comes next? A. What's A? Accountability. I.
Independence.
R.
Responsibility.
D. Oh, D. R. I.
Independence.
Oh, I think we had that one.
Yeah.
The other I.
Integrity.
Integrity. F. Fairness. And T. Excellent. Yeah. Now then, without looking down, Clarissa. Clarissa.
Prepare for tomorrow.
I don't care about tomorrow. I just want you to be perfect in December. Clarissa. Create an air of discipline and control, a culture. L. Lend me some money. Lend. You're reading it. You're cheating. Lend an air of credibility to the financial statements. A. Not 8. How does that add up to 8? Why do you think I'm twisting this hand up like this? What's that? 4. That would be 3. What's that letter? M, forum. Forum. A forum, to assist the CFO by providing a forum. What's R?
Chief Executive Officer.
No, the CFO is Chief Financial Officer. Chief Financial Officer. R? Review the financial statements to see if there's anything we can present better. I? It can only be one of two things, and it's not integrity.
Accountability.
It's not responsibility, it's not reputation, and it's not decision making or fairness. Independent. Yeah, bring independent judgment. One of the big characteristics of the audit committee members is that they should be independent. S, strengthen the role of the internal auditor. S, strengthen the role, the position of the external auditor. A, assist in dispute resolution between the executive board and the external auditor. And what's she called? Clarissa what?
Whistleblower.
Clarissa Whistleblower. Yep, Clarissa Whistleblower. Good. But you will remember that for tomorrow, won't you? Because we're going to start off with that tomorrow morning. All these mnemonics, we're going to start off with those tomorrow morning. So when you get home, you can say to your loved ones or your husbands, if they should happen to be the same person, you can say, I've got these mnemonics to remember.